If you have a Hong Kong company, you will eventually see this sent to your registered office address, the profit tax return from Hong Kong Inland Revenue Department. Receiving this often causes panic, particularly for foreign owners. You likely have many questions. How do I file? Do I owe any taxes? Or should my rate be 0% since I have no Hong Kong operations? Hi, I'm Raymond, a licensed CPA and tax advisor based in Hong Kong. My team and I have helped thousands of international entrepreneurs manage their companies and legally secure their offshore tax exemptions. Whether you are holding these letters right now or preparing for the future, these videos will answer all your questions. Number 1, your legal duty. Why you cannot just fill this out yourself, and who can. Second, the filing process, the exact steps to prepare and file your return. Number 3, the 0% claim. What really happens after you claim the offshore exemptions? And number 4, the worst case scenario. I will tell you several legal and financial consequences if you do nothing after receiving this profit tax return. Watch until the end to learn my practical experience so you know exactly how to handle this return and protect yourself from massive penalty. Let's dive in. First, let's reframe how you look at tax reporting. Many of my clients come from US and Europe, where you are used to self-assessment. In those jurisdictions, you report your numbers and the government used to take your word for it until they decide to audit you later. Hong Kong operates an statutory audit system. This is a critical distinction. The Hong Kong government does not want to hear your numbers directly from you. They require a third party to verify them first. You are legally required to appoint a practicing CPA like myself to audit your financial statements before this profit tax return is ever filed. Think of the CPA as a gatekeeper. They licensed by the Hong Kong government to review your bank statements, invoice, and contracts. This is where many entrepreneurs get an incomplete picture. They hire an agency to file the form, but they miss the most important part, the audit report. Without the CPA signature on that audit report, this profit tax return is essentially invalid. Now, you understand you have to work with the CPA directly to file this profit tax return. Then let's see what is the exact workflow you and your CPA should use to secure your 0% tax status. Here are the 3-step life cycle. Step 1, the initial strategy. As a CPA, before we even look at the tax form, we perform a feasibility check. We don't just take your Excel sheet or bank statements at face value. We need you to prepare and provide actual documentations, your sales invoice, purchase orders, shipping records, and even the email correspondence that shows where you negotiate your deals. We look at these documents deeply to trace your operations. Where your supplier, where are your customers, where did you physically sign these contracts? We have to validate your claim before we make it. Step 2, the registrations. This is the executions. Once we confirm your operations are truly offshore based on your documents, we prepare the statutory audit based on that findings. I sign the audit report, putting my professional license on the line to state your profits are offshore sourced. We then fill out the profit tax return, tick the specific box for offshore exemptions, and file it with the government. This is the formal registration of your claim. Step 3, filing the return is not the finish line. This is just the starting gun for the government review. You need a team that stick around to defend your numbers, because here is the biggest misconceptions. After we filed your 0% claim, does the government stamp it approved immediately? Of course, no. After filing, you enter a period of pre-approval. Usually, the government accepts the filing and you pay 0% tax for that year. But the government haven't officially agreed yet. They are watching and waiting. You will repeat this cycle, strategy, audit, and filed in second and the third year. Then usually after the third filing of your offshore claim profit tax return, the real work begins. The Hong Kong Tax Authority will likely open a tax audit on your offshore claim. They will send a detailed curious letters asking 30 or 30 detailed questions around your company's operations during the tax year. Where did you sign the contract? Where did you deliver the service? Show me your travel records of your directors. This is not a trap. This is a standard procedures. And if you and your CPA did the preparation correctly, back to step 1, you already have the emails, invoice, and flight record organized. You just reply to the government to prove your status with that documentation, and that is how you eventually secure your final letter of approval of your offshore claim. Now, I need to address a very dangerous myth in the offshore world. A lot of people think Hong Kong company is an open and one structure. In fact, a Hong Kong company comes with strict legal responsibility, and failing to meet them carries serious consequences. Let's look at 2 biggest mistakes. First, the do nothing approach. You receive the profit tax return, and because your bookkeeping isn't ready, you ignore it. What happens? Initially, it treats as a late filing. You will receive a late penalty letters with around 2,000 to 5,000 Hong Kong dollar penalty. Consider this is your first warning. If you continue to ignore it, the Hong Kong tax authority will issue the court summon. The government has the absolute powers to freeze your company's bank accounts and blacklist the entity. And do not think the limited liability structure protects you 100%. As a director, you have the strict legal duty to ensure the company remains compliant. In today's highly regulated age of KYC and AML check, failing these duties will remove that legal shield, meaning you can be held personally responsible. A court summon or frozen company accounts can ultimately harm your personal banking profile and reputations globally. Second mistake, unprepared for the offshore claim investigations. Let's say you claim 0% tax, but 3 years later, the Hong Kong tax authority audits you. They ask for proof because you didn't maintain your proper bookkeeping, your records IMS. You lost your sales invoice, you can't trace your transaction records, and you simply lack the evidence to back up your claim. If you cannot provide the evidence, your offshore claim will be rejected. You will immediately owe the standard 8.25% to 16.5% corporate tax on all those profits. But it gets much worse. Because you filed the incorrect return, the maximum penalty is 3 times of amount of the tax payable, plus the actual tax itself. The profit tax return is the official record of your company's life. It requires more than just the data entry. It requires a practicing CPA to perform the statutory audit and strategy to prepare for the future investigations. If you have received the profit tax return or your bookkeeping is behind, don't wait until the court summon. We handle the entire life cycle, the strategy, audit, and the defense all in-house. Book me a strategy call to review your situations. See you in the next one.